Assalamu Alaikum everyone, welcome back to another video. I hope you're having a great day. In today's video we are looking at one single stock, but before we do that I want to use this stock to analyze a couple of things, to look at a couple of things. We've got a lot of new members in the community, and what I want to do is they have been asking questions about whether things are Sharia compliant and things like that, and a couple of questions about the metrics that I'm using and so on. So what I want to do is go over that side of things before we start the actual video, so at least you have an idea of how you can analyze a stock and know exactly whether it is a Sharia compliant company or not. So that is really important. As a Muslim, the first thing you should be looking at is this business actually Sharia compliant? Once you've determined that, then you have to look at the financial matrix and just look at a couple of other things, right? So what I want to do is I want to focus on that. But before we do all of that, let's just have a quick summary of the earnings report so far, right? So far we are now, today's Tuesday, today is Wednesday morning, so we are waiting for some of the big boys to report this afternoon. Okay, so this morning and this afternoon. But just last couple of days, as you can see here, especially yesterday morning, 3M reported. Okay, Unilever reported, UPS. These are the companies that I own in my portfolio, and every single one of them, apart from UPS, I just need to go over that again, and just to make sure, I haven't looked at it. I just looked at basically the headlines, but I haven't actually looked at it in detail. Unilever, I looked at it a lot, and it really looks good. And I watched actually Bloomberg, the CEO of the company, and he was actually quite optimistic. And I like the fact that they have a price power in terms of basically they are actually passing a lot of he said I think 70% of they've increased their prices, basically every single product. Okay, about almost 70% of their basically cost they actually passing on back to the customers. And obviously because their product is actually well needed, that basically these customers will actually buy these products. And even that, they still reported a positive earnings report. But yeah, so it's heading in the right directions. 3M also reported, and they have announced that they're actually splitting the healthcare side of the business, and that includes the situation with the earplugs. That, remember that legal situation that's still going on. So this is what these companies do when they get into these kind of situations, like J&J, for example. They do this spin-off, so the company that had the issue, for example, now becomes a new business, and that therefore it's not the main company, if you like. So they are doing this spin-off, and their reports was really good. And for that reason, just on that morning, I think it was almost up 6%. Okay. The other thing I want to talk about very quickly is Microsoft. Microsoft actually reported their earnings last night, and I thought it was going to be really bad, but it was, every angle that I looked at it, it was really good. Okay, yes, they have missed a couple of things, but the most important thing, the one that the analyst was basically really not happy about, is this bit here. So their cloud services, okay, were expected to grow about 40%, right? They grew 40% instead of 46%. Right, compared to last quarter. So that's what they've done last year. So analysts were expecting 43% this quarter. That didn't happen. But 40% growth in a sector, it's, to be honest, that's amazing. But because this company has a higher multiple, a lot of people are paying a lot of price based on so much for this company. That's probably what they were expecting. So it does not look that bad. So first, when it came out, the stock was down almost to 4-5%, but then bounced back. I think it was up like 2-3% just last night. Okay, so again, nothing huge there. Visa reported as well. Okay, so they topped their earnings expectations, as basically the CFO basically sees no evidence of pullback in spending. So that means consumers are going out to buy their own stuff and get on with their lives. And there's no craziness going on out there. So that is basically it. So that's the three companies that I wanted to share with you. Alphabet, I think they missed us, I think, and it was down about 4-5% last night. I don't know what's going to happen today. Let's see what happens today. So we still got loads of different companies reporting, include tonight there's actually Meta. We've got Qualcomm, is one of the companies that I own in my portfolio. Sherwood Williams is reporting, West Management is reporting, and then on Thursday we've got the basically the big ones again. So in the morning we got companies like MasterCard, we got Pfizer's and so on, Merck, and then we've got Apple and Amazon reporting after the thingy closes, and then on Friday. So we're still not out of the woods yet. So yesterday the market was not actually happy with some of the things that was going on. So a couple of companies were down. Healthcare was still holding on. Okay, consumer staples, the beverage side of things was actually holding on fine, but the ones that were really down was the consumer discretionaries, especially Home Depot, because of Walmart came out and basically messed everything up. They were down almost 7%, right? So yeah, so that is just to kind of give you an overview of what's happening in the markets. But one thing I want to focus on today is this thing, right? So some of you are Sharia compliant. Basically, you're looking for Sharia compliant stocks, and because you want to invest in companies that sell halal products and so on. And these are the things that I look for. These are the things that I use an app called Zoya. Okay, I don't know if you know about it. I have no affiliation, nothing. I pay, I think, about £9 something or dollars or whatever every single month to have access to it. I use it to do my research and things like that. Okay, and so yeah, I have no affiliation, so you can go and check it out. And one of the things they do, they use this basically organization. There's an organization called the Accounting Auditing Organization for Islamic Financial Institutions, and they have different standards. So this is the company that a lot of the ETFs, okay, or the organization, a lot of the ETFs and basically use when they want. So there's loads of different scholars. So if you want to go and research about that, if you don't know anything about it, go and research and look at the people who are part of that, the scholars basically, those who are coming up with all these things, right? Like I've always said to you guys, I'm not a scholar. I don't know basically these kind of things. So alhamdulillah, I'm just following exactly what they have suggested, because they seem to know these things and they are basically well respected. And these are the scholars, or the standards they've created is actually what's used in when it comes to ETFs and so on. Okay. So some of the scholars in there are, for example, work with iShares and so on, to kind of guide them on what is halal, what is not halal. So these are the three things that we're looking for. Okay, so we're looking, first of all, we look in the business activity screen, and then we look in the financials, and within the business we're looking at the revenue. So what you want to do is just make sure the company that you're investing in has a revenue, okay, that doesn't have any revenue coming from gambling, adult entertainment, alcohol, pork, and all the other stuff that we know of. Okay. And what these people are saying is, these scholars saying it shouldn't be more than 5%. So less than 5% should be okay. But obviously, if you're getting dividends and things like that, then you have to obviously purify your dividends and so on. We've talked about that before. There's a video out there somewhere, how to purify stocks, whatever. Go and find it in my channel, okay? And then you got financial screening side of things. And then this includes interest-bearing debt. So what this means is companies might take on debt to finance their activities. So they need money they basically take a debt from the banks or whatever. That debt, okay, so the debt that generates interest should not exceed 30% or 33%. There's a little bit difference between certain scholars there, but 30 or 33%, that's what you will see in some ETFs. Okay, so don't get confused. Both of them I think it should be okay, but anything less than that, I've learned my lesson. Okay, recently I found out there's one of the companies that I owned had a higher debt, and it was compliant at the time, and then that was the, what's it called, Stanley Black and Decker. And I've talked about that before. I think the video is called The Mistakes I Made or something like that. But yeah, so I made that mistake. I bought this stock. I didn't know they had a higher debt at the time. And it was below the 30% threshold. But as soon as the report came out, it went literally almost 50%. So yeah, so you have to be careful. And again, even if you are not looking for Sharia compliant side of things, it's very important to look at debt anyway. You don't want to own a stock that has a higher debt. Basically, let's put it that way. Okay, whether it's long-term debt or short-term debt, companies should have a less debt if you are thinking about investing in them in the next 5 to 10 years, right? So that's the one thing. And then that's the second thing. So the next one is interest-bearing securities, and this is the amount of deposit, investment, or debt company extends with the aim of receiving interest on it. So now they're giving out deposit, they're giving out some investment, they're actually giving out some debt, right, in order to gain something, to receive interest on it. So like they're giving, basically, they're like the bank right now. They're giving out something. So in order to receive basically some sort of a reward for it. And that reward is the riba side of things. Okay, that's the interest, right? And that should not go above 30%. And that's really all basically it. So these are the three things. Look at the business and see, okay, do they sell these things? If they sell, go away. Find another company. There's millions of companies out there. I'm exaggerating, but there's thousands of companies out there. Okay, interest bearing. Okay, do they have a lot of debt, and are they basically spending basically 30% more than, or 33% more of that, basically paying interest kind of side of things? Okay, and are they receiving interest that's above 30%? So once you've done these things, then you can start looking at the financial side of business, the basically the matrix that we're normally looking for, or the attributes, right? Some of this one is quite straightforward. You just have to look at the business model and look at their products that they sell and find anything that is basically meets this criteria. These two things is easy to actually calculate. You can find that information. You can do it yourself. Okay, so interest bearing debt, what you can do is this total debt, and you can find this in Yahoo Finance, Seeking Alpha. There's millions of different websites that have that. Total debt divided by the market cap times by 100 will give you a percentage. That percentage is basically then what you need to look at. Okay, so that's all you need to do. If it's above 30% or 33%, then just leave that company alone. Okay, then the second thing is also the same, the interest bearing securities. You're looking for cash, so you're adding the cash, and this again you can find in Yahoo Finance and so on. Cash equivalents plus deposit, these three things, okay, divided by the market cap times by 100 will give you another percentage, and that percentage is basically what you will look for. Okay, below 30% you should be fine. I would say genuinely if it's above 20-25%, okay, just leave it alone. That could change very quickly. So that is it. That's from Sharia compliance side of it. Go to this website, find out what these people do. This is not from me. I'm not a scholar, but they're the ones who are coming up with these things, and they seem to be well respected within the industry. So I am following their footsteps, and I'm reading about certain articles they publish and so on. So the next thing we're going to look at is the key attributes. This is what I look for, okay? And sometimes it changes all the time, okay? It's quite fluid, these things. So I'm looking for earnings growth. So I'm seeing if the EPS is actually growing, if the revenue is growing. Do they have a profit margin above 15%? Return on equity, is it actually above 15%? So this actually helps us when you invest in a company. You want that company to take that money and do something useful with it. So the return on equity actually will tell us about that. Okay, then you got free cash flow growth. Is the cash flow growing? Not only do they have cash flow, is it actually growing? Because that's really important, because like we always said, the free cash flow is what they use to pay you these dividends, buy back their own shares, pay off debt, okay, acquire other businesses, grow their own business line, and so on. Those are the things that the free cash flow is really important. Then we're looking for, is this company a fair value at the moment? So once you've determined it's a profitable business, is it actually cheap? Is it undervalued at the moment? So a lot of the companies that I use, for example, Morningstar, will use something called discounted cash flow model, okay, which kind of predicts where the business should be in the next 5 to 10 years, or maybe next year, whatever, right? And based on that, I can just say if it's undervalued, then you can add that, and then maybe have a margin of safety as well. If it's undervalued 10%, maybe just wait until it drops to 15%. So give yourself about 5% margin of safety. And then do the company has a strong balance sheet? Okay, so do they actually have, when you look at their balance sheet, we're looking at the growth of the revenue, we're looking at the net income, we're also looking at the liabilities, assets and liabilities. So the assets are the things that the company owns, liabilities, things that company actually has to pay for. So if they have a higher liabilities, then stay away from them, because then that means actually they're not really going to be compliant, because they can have a lot of debt to basically pay off and stuff. Then do they have a clear competitive advantage? That's another thing that you're looking for. Okay, so do they have that? If they don't, then you're just gonna have to maybe find a company that is that actually the industry leader, if you like. Okay, but again, having a clear competitive advantage doesn't mean your business is going to be successful. It just means basically you stay ahead of the game, if you like. Okay, so it really helps with these that's one of the things I look for. So do they have a wide economic moat? And if they do, then perfect. Forward-looking growth perspective. So in the next 5 years, is the business going to grow? If it's no, then you stay away from that business, because what's the point? I sold recently Pfizer because I was slightly concerned about their reports in next report, which is actually coming out today or tomorrow. I think it was today, right? Yeah, tomorrow. So one of the reasons I sold it is because they forecasted to actually to slow down. Basically, their growth is going to slow down because of the COVID vaccine and so on. Then your stock performance in the last 5 years. Normally what they say is that every 5 years the stock price should double. Okay, not necessarily. Companies like 3M has not done that for a long time. So yeah, sometimes this is the kind of weak one. I don't really bother too much on that. Okay, and the final thing I want to talk about is the dividend side of it. If the company that you invested in pays dividend, then basically I normally look for something above 1.5%, dividend safety just above 61%, and then payout ratio of basically less than 60%. Okay, and because you want the company to grow their dividends, right? So dividend streak again over 10%, over 10 years, sorry. So if they have increased that dividend for 10 years, then they are heading towards different something called dividend aristocrats, and that is really important. Okay, and if that's the company, if the company is heading that direction, that they're not going to cut that. They will make sure that, you know, and companies that pay dividends, companies that have actually are profitable, right? Dividend growth, okay. And then for the last 5 years, basically last 5 years, have they grown this dividends for 7% or more? Normally 5% is okay, 10% is even better, 7% is kind of medium. Okay, so yeah, so these are some of the things that you look for in terms of dividends, in terms of this, and then in terms of the halal side of things, right? Let me very quickly, this video is going to be longer than I expected, but the company that I want to talk about today very quickly is AbbVie. AbbVie is in the healthcare sector, currently trading $150 per share right now. So once you've done these things, right, the other thing you need to do is actually go and find out what this company sells, okay, and their product line, and basically understand the patent, for example, they have. Is it expiring in the next, especially for pharmaceutical companies, okay? Do they have a patent? And if they do, is it going to expire anytime soon? I know AbbVie is actually got this Humira, whatever it's called, and it's expiring, I think, very soon in the US, but they have a product line that is quite long, so one of these basically products might actually be might take over kind of thing. Okay, so you just need to look at the business model. EPS, you can see, is almost doubling next year. Market cap $268 billion. They have economic moat which is narrow right now. Beta is lower than 1. PE is quite high. Okay, 23 is the sector, 21. The healthcare sector has been going up while everything else has been going down. Okay, so free cash flow, it looks like over expensive right now. I'll be honest with you. When you look at these two metrics, is actually quite expensive. Dividend yield over 3%, and this is what attracted me to this company, right? 3.74, 5-year growth rate 18%, dividend growth streak of 50 years. Now the company is quite new, but they were spin off from AbbVie, okay, so and Abbott Laboratories, and because of that they actually still hold that dividend king status. Payout ratio 76, so that's quite high for me. Dividend safety only 70%. Again, that should be higher, but they have a free cash flow of $22 billion, and the 5-year growth, the revenue grew in the last 5 years about 17%, earnings grew about 14%, and the profit margin almost 22%, operating margin 32%, return on equity 85%. Okay, so it looks like this company has done really well in the last 5 years. So let's see how it's going to do in the next 5 years. Total returns, we're looking at for the last 5 years, only 5 years for this company because they haven't been around for 10 years, only 19%, which is really good. Cap ratio, now this is where the issue is, right? This company looks like it's got higher debt, so it should be above 1. This means basically next 12 months the company might not be able to pay off that debt, okay, they have right now. And the final thing is this growth estimate for the next 5 years according to Yahoo Finance 0.3, and that as soon as I saw that I was like, no go, I'm gonna leave this company alone, okay, because that's not enough. Okay, 3-4% normally I expect the consumer staples from healthcare. Nah, definitely not. Simply Wall Street is saying 60% undervalued at the moment. Their price tag is 382. They're very bullish on that. I agree with Morningstar, 20% premium, $125 per share. That's where the price should be. Tip rank is just 162. Yahoo analyst is 163, and according to tip rank is actually moderate buy, which I kind of agree or hold at the moment because of that. Okay, so that's it. That's what I wanted to share with you guys today. I wanted to show you how you can actually do this yourself and some of the key things to look for when you're doing this. Again, there's so many other things. This is not it. And I'm not saying I'm a financial advisor. I know what I'm talking about, but these are the things that make sense to me. So when I'm talking about basically earnings growth or revenue growth, you have to own a company. That if you want to own a company, you need to know how are they going to make money. Okay, is that actually increasing year after year? And if it is not, then what's the point of investing in that company, right? So some of these things make sense to me. That's why that's why I try to simplify as much as I can. If you enjoy this kind of content, please like the video, subscribe to the channel. Let me know if you have any questions. Assalamu Alaikum.